This is our Forex blog for June 7th, 2013, and in my opinion, this is the easiest way to trade. There's literally hundreds of ways to trade with our software when you combine all the different unique tools, statistical tools that we've come up with. But the highest probability way of trading, I would say, is this, because it allows you to anticipate future trend direction with a very high degree of accuracy. For instance, this is our currency index, which basically shows you visually what every currency is doing. And you can see the dollar. It's above its hourly moving average, more likely to go up. When it breaks down right here, it's likely to trend down, and it does. Find support at the lower containment band, which you can see also this one did here, this one did here, this one went above it, this one found resistance here, support here. Most of the time at our containment bands, price reverses. So again, it's an anticipatory way of trading. You can see on the chart, for instance, a trend line on the euro. And when this trend line gets broken, and or it also finds resistance and can't get above the previous day's high, this is where you start looking for sells. And it doesn't go down here. You might have had a loss. It comes back up, can't get above the high. You have a double top here. Without having the euro index, you wouldn't know at 130 to look for sells in the euro, for instance. So let's link all these together. So when I scroll one back, they're all scroll back. Which currency is either going up at 130 or is likely to go up? Well, the dollar's going up, the yen's very weak, looks like the pound's potentially breaking out over the previous day's high, but we would probably want to see, get some kind of confirmation for that. It doesn't necessarily go above that. But the euro's double topping here, the dollar's trending up, although the weekly trend's down in this one, and this one's extremely weak, the longer term. The CAD was quite strong today. It's kind of going sideways. So I would look at 130, the highest probability in my opinion, by just looking at this real briefly, would be the Euro CAD for a sell. It doesn't mean the trade's going to work, but it's likely to work. And so here's 130. And this is what's nice about this is you can see that this chart's underneath the hourly moving average, right? So the trend's clearly down. This is a pullback trade. It also happens that our perfect oscillator is at the extreme overbought condition. Anytime you get a trend down and it gets up to the 80 level, and or it gets to or above our upper Bollinger Band on our perfect oscillator, it's very high probability reversal. And you can see the price then goes down 75 pips. Now you're not always going to get 75 pips like this, but like I said, very high probability predictive way of trading. Now let's take a look at 130 here. Selling the euro pound because this one looks like it's going to reverse. The pound, looks like it's about to bust through. Well, it's really kind of iffy. I would wait for confirmation here because they're both at the previous day's high. Another thing you can do when you see a currency going up, let's say the Australian, the daily trend's down, the weekly trend's down. You can see that color strip on the bottom. When you draw your fibs off the previous swing like this, you have this as a fib target. Because the longer term trend's down, because it made one wave up, this is the second wave up, the fib targets by themselves are very predictive, but when the daily trend's blood red, the weekly trend's blood red down, this is a very high probability at 240 right here, 2:50 in the afternoon, it's likely to pull back. It doesn't mean that you're going to get a reversal the rest of the day, but it's likely to go down in the short term. If this one goes down and you sell it against one of the stronger ones, you can see here the dollar was trending up, and this one actually has pulled back, and it's right near its hourly moving average, which is a support area. Usually price stalls at the hourly, at least a little bit. If you notice, all the other currencies today, when they hit their hourlies, notice how often they stall. So if they do stall in reverse, like typically happens, this, again, like I said earlier, predictive methods. Now, the Australian's at its high. It's gone up for many hours. It's likely to pull back. The dollar was strong earlier, and it's kind of drifted down really slowly, not with a lot of weakness. You can see the daily trend is slightly up, and the weekly trend's down, but the daily and weekly trend on this one's down. So at 2:50 or so, let's again find the exact time, 2:50, 2:55, the Australian dollar, very high probability one to sell. 255. Here is 255. And you can see, just like, and this happens the majority of the time. That's why I call it very accurate, very predictive. This perfect oscillator is also at an extreme. The trend was down all day. You know, it's not the best trade in the world, but you can see it fell about 10, 15 pips and kind of went sideways. Any way you look at it, you would have made money on the trade, whether it's 5 pips or 10 pips or 12 pips. It doesn't really matter. Double tops, double bottoms, fib targets. You know, one of the better ways of trading, let me make this bigger just to showcase this. When you have a currency that goes underneath its previous day's low, that is one heck of a high probability that it's going to continue down. And you also know ahead of time what your likely profit target is. For instance, you draw your fibs on this. Oops, let me put that back. Draw your fibs on here. And usually the fib target's going to be a profit target. So sometimes you have a downtrend today, but the daily and weekly trend are up. When that's the case, it's a pretty high probability to buy at the lows, especially at fib targets, especially at our lower containment bands. You get short, and you know whether it's here or here, and this is a great profit target at 9. Let's look for sells in the Australian from 7 to 9 and look to get out at 9. So not only does it help you get in, but it helps you get out. So which currency, when this thing was hovering at its not only 50% fib retracement, hourly moving average, right around the previous day's low at 830, which one was super strong? It wasn't the dollar, it wasn't the euro, because they're both underneath their hourly. The yen was strong at that time. The CAD's also strong, and the Swiss isn't that bad. You know, Swiss is kind of going sideways. If it breaks out after having a very narrow, choppy action all day, you're likely to get a big move. So I would say sell the New Zealand Swiss. The yen is already up near its upper band, so it could very easily reverse here because usually price does reverse, but we'll just take a look at it. Selling the Australian yen at 830, and my preferred favorite, what I would personally do, selling the New Zealand Swiss, which I'm not sure if even most brokers have that one. Okay, so 830 on the chart is right here. Notice this one also retraces up to its hourly moving average. Notice our perfect oscillator is both at the plus 80 level extreme and it's at the Bollinger Band. Sometimes it hits the plus 80 and is not at the Bollinger Band. And on top of that, the moving average of our perfect oscillator is actually kind of sloping down and underneath the 0 level right here. So this is a very fast indicator. It does not use look-back periods. It uses I won't get into the math behind it, but it's an insane complexity of math that compares how big each move is compared to this time of the day, and it rates it, and also has a digital signal processing based moving average of it and Bollinger Bands around it as well. You know, because when you have, especially at the beginning of a downtrend, let's say this was going up and then it goes down right here. When you get a pullback after a big move down to the upper Bollinger Band, it's a pretty high probability place to sell. And, you know, it's even higher probability if it's at the plus 80 level. It's just, there's, you know, because the trend's down, there's nobody left to buy. Notice also again right here, pull back to the hourly, at an extreme, and another 20, 30 pips down. But again, 830, it was very likely that the New Zealand Swiss was going to reverse. Let's take a look at the New Zealand yen at 830. Now, the only reason this isn't going to work at 830 is if the yen, like I said, it was already up too much, it all of a sudden reverses too, and it goes down faster than the New Zealand does. Then the New Zealand yen could actually go up because the New Zealand's falling at a slower pace than the yen is. I mean, you know, so that's a possibility. But you can see here at 830, it does go down for the next half hour, and at 830, our perfect oscillator is at an extreme. One thing to be aware of here at this level is our perfect oscillator reading is sloping down, which is in a down, you know, it's starting to go into a downtrend. However, it's above the 0 level, which means you know you can get a reversal and then quick back up. When you have moves up here like this, when the moving average, the white line in the middle, is underneath the 0 line in the middle, it's a little bit higher probability. For instance, from here to here, it's underneath the moving average. And so up moves like this, very high probability, and you can see what happened. You know, as you learn, as you watch our tools, even for a few days, especially the perfect oscillator, you just will find all kinds of trades to use with this, and you can set it for all kinds of different time frames. I have this set to 5 minutes because it's on a 5-minute chart, but you could have a tick chart up, a range chart, any kind of chart you want, and have this same 5-minute statistics on there. This is also a perfect example of when you have a trend that's so far down, so weak, when you get a move to the upper containment bands, again, it's a very high probability place to sell. You could just simply wait for price to just break down below the previous bar's low. You would risk this amount and just kind of trail your stop over the bar's high. Maybe you get out here with 40 or 50 pips, or you got out half your trade, you put your stop here, it goes down again, you draw your fibs on this, and here's your fib targets. You would most of the time make the maximum profit at the 1.618, which is right around here. You can see it went a few pips underneath that, 9 pips underneath that, and then flip back up. And also note, on the way down, if the perfect oscillator gets underneath the minus 80 level, you probably want to look to get out of your trade, because the majority of the time, price reverses. Now, not always, obviously, but usually soon afterwards. You can see price kind of stalled here, made one more wave down, and then exploded up. Earlier, these levels here, kind of price went sideways for 30 minutes, shot down, and then exploded up a lot. This level right here, into the move. Now, obviously, when the trend's down, it's much more likely to continue its trend underneath the minus 80 level. When the trend's down, the plus 80 levels are extremely high probability places to sell. Here, here, and here. Obviously, this one here didn't work. Why didn't this work? Because we're underneath the lower containment band, and typically underneath the lower containment band, price reverses. This is why one of the rules I frequently say is, you know, be very careful, and new traders should just avoid selling underneath the lower 2.0 white band. This trade here works because guess what? We're above the 2.0 band. It's reset, price has reset itself. And also that trade's better because it's a two-wave pullback. When you have a strong downtrend and it's way underneath the lower band, wait for a two-wave pullback and then look to sell. And when you can sell at the 1.618 and this is so weak, you know, it's just a beautiful thing. There's high probability trades. So again, use our currency indexes. You can get our software for free by opening a live account with one of our brokers, or you can buy our software for $2,000, lease it for $150 a month, or $200 a month with the data. And we use eSignal data. You do need eSignal data to use our software, and many of our brokers will pay for the eSignal data for you if you trade the minimums, which kind of range per broker, but it's very reasonable. Most people can do it in a week or two, let alone a month, if they're serious about trading. People with small $500, $800, $1,000 accounts, you know, maybe not. They probably should open accounts with Forex.com, which has a much smaller minimum. Or you can, if you want, just pay for the data from us, $50 a month for the data, get our software for free, and then there's no monthly minimum. You don't have to worry about it. The brokers charge more. I think it's $115 if you don't do the minimum.